Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
New week, new opportunities. Welcome to Modern Investing Techniques, episode 91. I'm Patrick in Vancouver. Today is June 29th, 2026. New week. Let's see what opportunities the markets are presenting. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Tech debt issuance is accelerating as AI infrastructure costs climb, giving Canadian investors in TFSA accounts a chance to tilt toward investment-grade corporate bonds from U.S. tech names rather than chasing equity volatility. The S&P 500 sits at 7,354, flat on the day. The NASDAQ Composite is at 25,298, down 0.2%. The TSX Composite is at 34,980, up 0.4%. Mixed global shares reflect extended tech losses in Japan and South Korea, while U.S. futures edge higher after last week's modest declines. The Bank of Canada decision window remains open, with markets pricing steady rates into July, while the Fed's next meeting looms with limited easing expected before September. AI-related debt issuance is on track to push total investment-grade supply above $2 trillion for the first time in 2026. Lifting financials and industrials while pressuring pure tech equity multiples. About 14 days ago, the simulated book added Roku on an M&A spread capture thesis, tied to an announced transaction. The position closed flat at the end of the review window, producing zero alpha relative to the benchmark. The outcome illustrates how announced deals frequently require extended holding periods before any spread convergence materializes. Market participants must therefore size such positions for patience rather than rapid resolution. Liquidity in the name remained adequate, yet the catalyst itself did not accelerate within the expected time frame. This result reinforces the need to model time-to-close assumptions conservatively when entering event-driven names. Our simulated portfolio shows a cumulative profit and loss of $263.15 across 41 trades, with cumulative alpha versus the NASDAQ at plus 11.0% across 30 benchmarked trades. While bonds offer a steadier path, let's see how we're translating this macro signal into today's simulated equity position. Corporate bond issuance by U.S. tech giants offers a lower volatility way to gain exposure to AI spending without riding equity drawdowns. When companies such as Microsoft and peers tap foreign bond markets to fund data center buildouts, the resulting investment-grade paper typically carries spreads that compensate for duration risk while remaining senior to equity. Canadian investors can access these names through USD-denominated corporate bond ETFs, held inside a TFSA, capturing yield while avoiding the 50% inclusion rate on equity capital gains. Implementation starts with screening for recent issuance on platforms that show real-time bond data, then sizing the position to 5 to 8% of fixed income sleeves so that rising rates do not overwhelm the carry. This approach has historically performed best in mid-cycle expansions when earnings growth supports credit metrics, but equity valuations already price in perfection. The main risk is spread widening if AI capex disappoints, which is why a hard stop at 3% below entry price on the ETF is required. That same credit market signal drives our practice investment pick today. This is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. Today's pick is Microsoft Corporation on the NASDAQ. The strategy is a bond market proxy play on sustained AI infrastructure spending via equity exposure to the largest issuer of new tech debt. The catalyst is record AI-related debt issuance projected to exceed $2 trillion in 2026, with Microsoft as a primary issuer funding data center expansion. The technical setup shows price action below the 50-day moving average after recent sell-off. We monitor the 20-day volume average for any rebound confirmation before adding. Risk assessment points to further equity multiple compression if weather-driven data center costs rise faster than expected, so the stop loss is set 6% below entry. The target is plus 2% to plus 5% over the week if debt markets remain orderly. Confidence level is medium because we have a strong fundamental driver from issuance data, but a single factor setup without volume confirmation yet. This trade demonstrates how to translate macro credit market signals into an equity position while respecting sector concentration rules. Listeners learn to size exposure to the actual capital spending cycle rather than headline AI hype. Before we check how yesterday's flash trade performed, here's a quick reminder on passive versus active realities. Imagine you bought an S&P 500 ETF last week when the index dipped 0.8% on geopolitical headlines. Your fill came at the exact closing NAV because the ETF's creation redemption mechanism keeps tracking tight. The mechanism works because authorized participants arbitrage any premium or discount in real time, keeping expense ratios under 0.05%. while delivering the index return minus that tiny fee. What most retail investors do not realize is that the same low-cost structure also prevents tax loss harvesting opportunities that active managers can exploit inside the same account type. Professionals always check the SPVA scorecard before deciding. Over 85% of active large-cap funds have underperformed the S&P 500 over 15 years, yet the same data shows active small cap and emerging market managers beat their benchmarks roughly 40% of the time. The biggest mistake with the passive versus active debate is treating it as an all or nothing choice. Instead, always run a core satellite test. Keep 70% in low-cost index ETFs for market beta. Then allocate the remaining 30% to active sleeves only where the SPIVA outperformance rate exceeds 50%, and your own due diligence confirms repeatable edge. Speaking of evidence, let's review yesterday's flash trade result. Yesterday's flash trade was MU on an AI momentum entry using an earnings revision catalyst with volume confirmation. We entered at $1,233 at market open and exited at $1,213.56 at market close. The result was a loss of 1.58% or $15.77 on a $1,000 position. The trade lost 1.58%, while the NASDAQ fell 0.2% over the same session, for negative 1.38% alpha. The earnings revision catalyst reversed intraday once broader cost concerns resurfaced. This confirms that single-day momentum entries require tighter risk controls. The new rule is to require closing price confirmation before declaring any catalyst trade complete. To help execute these rules cleanly, here's a tool worth adding to your workflow. TradingView supplies real-time charting, multi-time frame technical scans, and community idea sharing across stocks, ETFs, and Forex. Canadian investors gain an edge by building custom watch lists that combine RSI, moving average crossovers, and volume alerts inside one browser-based platform. The free tier is sufficient for most TFSA users. Paid plans at roughly $15 per month unlock deeper backtesting and broker integration. 3 quick hits to close the show. Deep Sky delivered North America's first verified direct air capture carbon credits. The credits were purchased by Microsoft and Royal Bank of Canada, establishing a concrete revenue path for the Canadian developer. This transaction creates an investable theme centered on carbon removal infrastructure that sits outside traditional energy or utility sectors. The credits carry verification standards that institutional buyers require, reducing execution risk for future projects. Canadian investors seeking exposure can screen global clean tech ETFs that already list carbon credit developers among their holdings. Any position should be conditioned on a close above the ETF's 50-day moving average to confirm momentum. The theme remains early stage, so allocation size should stay modest relative to broader thematic sleeves. Comcast announced plans to execute a tax-free spin-off of NBC Universal and Sky into a dedicated media unit. The separation will allow distinct valuation multiples for the media assets versus the broadband infrastructure business. Investors will receive shares in the new media entity on a pro rata basis, preserving the existing Comcast ownership structure. The broadband segment is expected to retain higher growth visibility once separated from content cyclicality. CMCA should be monitored for any post-announcement volatility that creates an entry below the pre-spin level. The transaction timeline remains subject to regulatory approvals, introducing a modest event risk window. Separate trading of the media assets may also unlock incremental value through potential strategic interest from pure-play content buyers. Severe weather is emerging as a direct cost driver for AI data center operators. Heat waves have increased both insurance premiums and physical repair expenses at facilities operated by the largest spenders. These incremental costs arrive precisely when capital budgets for new capacity are already elevated. Operators must now model weather-related downtime into projected returns on AI infrastructure. The development introduces a new variable into equity multiple compression scenarios for pure-play tech names. Investors holding concentrated tech exposure should therefore prepare to reduce positions by approximately 5% if the NASDAQ Composite closes below its 20-day moving average. The risk is no longer theoretical. Weather events have already produced measurable margin pressure in recent quarters. Finally, put today's bond yield lesson into action with this week's listener challenge. Open your brokerage platform, search for a broad investment-grade corporate bond ETF that holds recent tech issuer paper, and note its current yield and 30-day SEC yield side by side. Subtract the ETS expense ratio to see the net carry you would earn inside a TFSA over the next 12 months. Our simulated portfolio now sits at a cumulative profit and loss of $263.15 across 41 trades for a 51% win rate. Average return per trade is plus 0.64%, and the current streak is one loss. Before we wrap, I've got my eye on how the new rule on closing price confirmation plays out in tomorrow's setups. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. And before you go, this show is part of the NARA Network, a family of daily podcasts on tech, science, and markets. Each one a short, sharp briefing you can finish on the commute. If today earned its place in your feed, here's your next listen. Planetarian Daily, daily breakthroughs in science, health, and longevity. Find every show free at naranetwork.com. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't laugh?